Hello, everybody. Oh, the mic works. That's always good news. Welcome, everybody. I'll let you all come in and take your seats. Thank you all so much for being here. I was thinking about tonight earlier today, and I just want to kick things off by noting that it was a beautiful 85-degree day in Richmond, and a bunch of you still turned out here. So that tells me that this topic is important, and you care a lot about it. And we care a lot about it at the Richmond Fed, too. And we also have a very large contingent online that I'm happy to welcome here tonight. Thanks for being here to learn about inflation. My name is Renee Haltom. I'm the regional executive for the Federal Reserve Bank of Richmond's Richmond office, and I am the host and moderator of District Dialogues. And tonight kicks off our 2022 to 2023 season of District Dialogues, which we're excited to cover the topic of inflation here tonight. I'm also excited to be here because my personal feeling is that when inflation is high, it's a responsibility of the central bank to take time and explain it to the public and try to be as transparent as possible. And so that's what we're doing here tonight. I'm not going to waste any time tonight. We have a very simple agenda. I'm going to kick things off with a bit of a level set on some of the basic facts about inflation, sort of why we're all here, why we're all excited about it, why people are talking about it. Then I'm going to welcome Tom Barkin, president of the Richmond Fed, to give some of his thoughts on why we're experiencing the inflation that we're experiencing tonight. And then we're going to jump to the panel that we have tonight. And keep in mind, there will be a chance for Q&A at the end. So please be thinking of your questions. If you're online, be answering your questions into the chat, and we'll get to as many of them as we can tonight. And I also will just quickly share the disclaimer that the views I'm going to share tonight are mine alone and not those of the Richmond Fed or the Fed system, and that applies to all of the panelists and speakers tonight. So just get that out of the way. And so with that, I'm going to dive right in. Okay, so what is inflation? And in particular, how is it measured? And this is, again, to level set on what the issues are today. Okay, so why are we talking about inflation? Well, you all are sitting in the Richmond Fed. We are the central bank. The Federal Reserve is the central bank of the United States. That's the entity that influences interest rates to help support a healthy overall economy. That's what we call monetary policy. And inflation is one of our main jobs in monetary policy. I've got a picture of our monetary policy mandate on this slide. That's a mandate that was given to us by Congress. And they say that when you conduct monetary policy, you have these three goals: maximum employment, which we interpret as employment, a labor market that is functioning as healthy and as sustainably as possible over the long term; stable prices, which is, of course, inflation; low and moderate price growth. And then we have this third mandate of moderate long-term interest rates, but you really can't get that if you don't get the first two goals right. So we sort of lovingly call this the dual mandate. And then let's say another word about inflation, just to make sure we're all clear on what we're talking about. So inflation is not just when the price of one good goes up, say the price of gas, or even the price of milk at the grocery store. Inflation is when you're seeing a broad increase in average prices that's sustained over time. So it's a particular definition that we have there. So now that we've got those facts out of the way, this is why we're all here, right? We are, of course, seeing the highest inflation that we've had in 40 years. So this chart, it's a little hard to read the details, but it shows two measures of inflation, just to give you a flavor. It shows personal consumption expenditures on the left and the consumer price index on the right. So just two measures of inflation. And what they do is they take a basket of goods and services that people buy, they assign weights to those baskets, and then they measure the average price of that basket over time. And you can see that they're both showing kind of a similar trend, comparable trend. And also for each one, we've got overall inflation, which is the dark blue line, and then core inflation, which is the red line. Core is a measure that strips out food and energy prices, not because they don't matter, not because economists don't eat or drive cars, but because they obscure the overall trend. So when we look at core, it gives us a better idea of what the overall trend is doing. And so you can see that by any measure, inflation is high right now. Under PCE, the overall measure is coming in at 6.5, and core is around 4.5. And in CPI, the measure is coming in around 8, with the core measure of 6. The Fed targets 2% inflation over time. That's the measure that we've said is sort of consistent with price stability. It's not inflation that's so high that it's distorting and disrupting the economy, and it's not so low that it's risking deflation or falling prices, which is a different economic problem. So by any measure, inflation is too high. And this chart also tells a bit of a story. So the data go back to 1960, and you can see that a few takeaways here. Number one, we haven't had meaningful inflation for about 40 years. The last time we had high inflation was in the 1970s. And in that episode, it was much more severe in terms of inflation. Inflation was higher, it was higher for longer. And then we had this moment where inflation came down, but then spiked again. So this 1970s experience was a worse one. A second takeaway is that we learned something about letting inflation come back after it seems to have gone away. We learned an important lesson about being consistent with our policy until inflation is truly tamed, because in the 1970s, it came right back. So that's another sort of lesson we took from the 1970s. And then a third takeaway from this is that when the Fed acted very strongly to bring inflation down in that prior episode, it sort of convinced the public that we were going to be serious on inflation. It bought us a degree of credibility that we would do what was required to bring inflation down, because we caused a pretty steep recession then. And so that credibility has helped to keep inflation low since then. We've also been fortunate to benefit from good luck in the economy and how the economy is involved, but the Fed's credibility in saying we care about inflation, we're going to do what we need to do to keep it down, has helped us in the time period since the 1970s. And so going to the current episode, current inflation is now both broad-based and it's persistent, and that's not so good. So this chart shows you the components of inflation, the particular goods and services that are going up in price over time in the consumer price index. And so I said inflation is broad-based and persistent now, and this was not the case through the entirety of the COVID experience. So this chart starts in January of 2020 and goes through currently. And if you go back to the spring of 2021 and you look at these components, look at that gray bar, for example. It's the vast majority of the inflation we were seeing at that time. That gray bar alone is used car prices, right? So it's sort of easy at that point to tell a story of, okay, this is about COVID supply chain disruptions, and it's not obvious that Fed policy is the appropriate tool to deal with car production and a shortage of chips. It seemed unique to the COVID experience. Another thing you could look at is that yellow bar. That is airfares, and then also there's hotels. These are categories that were just coming up from COVID sort of rock bottoms. And it was easier then to tell a story that inflation was not really broad-based. It had to do with particular circumstances due to COVID, and though not necessarily something that would be all that responsive to Fed policy. Now that story started to change in the fall of last year. So in particular, I'll draw your attention to that green bar. That's the everything else category of inflation. Around the fall of last year, that green bar started to get larger and more persistent. You start to see also that red bar, that is owner equivalent rent and rent. So essentially the housing market, right? And the hot housing market that we've had. And that's a component that's gotten larger and more persistent over time. So in the more recent months, in the last 18 months, we've seen inflation become broader and more persistent. And this is, of course, why you've seen the Fed and the public talk a lot more about inflation. You can't talk about inflation without talking about the labor market as well, because what's happening with labor shortages is something that everyone is feeling and paying a lot of attention to. And over the experience since COVID, we've had a lot of wage growth. Those of you who are employers tonight, I'm sure, feel what I'm talking about. So the top bar the top line in this chart is nominal inflation. And so nominal wages. So we've seen wages go up, but if you adjust wages for inflation, wage growth has been negative. So actually real wages have been falling. That's the lower bar. And so to my mind, this raises important questions about what's driving inflation right now that I think our panelists will talk a bit about. In particular, people have wondered, are we in some sort of wage price spiral, which is a situation where people are feeling inflation, and so they're asking for higher wages, and so employers have to raise prices more to cover that cost, and it becomes a sort of cycle that's hard to stop. And our panel will talk more about that tonight. Inflation expectations are also a really important part of how we think about inflation. So if you want to manage inflation, you need to think really hard about how the public expects inflation to evolve. And the reason is that if people are expecting inflation, they will tend to price it into their their wages, their contracts, their decisions today, making inflation a self-fulfilling problem. So we care a lot about what markets expect inflation to be. There are lots of ways to measure inflation expectations. These are just two derived from bond markets. They essentially say, what is inflation going to be 5 years from now and essentially 10 years from now? And this is a slightly more positive story. You saw inflation expectations start to rise, but then at the beginning of this year, when the Fed started to make some stronger statements about inflation expectations started to come back down. And this tells me that markets seem to be listening to what the Fed was saying about inflation and seem to trust that to some degree that we would do what's required to get inflation down. Now, I say that, and I wagered to put on this chart that this is a good thing, but I think it's something that we can't take for granted. And I know this is something our panel is going to get into more tonight. We need to make sure that we're doing what we need to do to convince people that we are going to do what's needed to keep inflation down so that inflation expectations stay anchored. And then, of course, many of you in this room tonight will know that the Fed has taken significant action to counteract inflation. In particular, we've raised the federal funds rate pretty significantly this year. So this chart goes back to 2000, and it shows the Fed's main policy interest rate. And you've seen that this year we've raised rates really fast, at a historically fast clip, in order to counteract inflation. As of today, our Fed policy rate is somewhere around 3.8%. So that it's a pretty fast rise that we've made. Now, our panel will talk more about the course of Fed policy, but I want to put one sort of notion in your head, is that this chart only goes back 20 years. Interest rates are still historically low relative to sort of a longer historical average. There are many points in this slide where interest rates were basically at zero. And so when we've raised interest rates, there's a point at which interest rates in the economy actually become restrictive. So there's sort of a neutral level where interest rates are neither stimulating nor depressing the economy. And many estimates of that neutral level are somewhere around where we are today. So we've just started to be restrictive on inflation. And so that leaves open this question of what will happen going forward and when our policy will start to hit the economy. And so that's something, again, our panel will talk more about today. And so with that, there's some basic facts out of the way. I'd like to call up Tom Barkin to the table. He's the president of the Richmond Fed. He is one of the policymakers at the Federal Reserve who sits on our interest rate setting committee. And so he's going to share some of his thoughts on the inflation that we've seen.
Can you hear me? Good. Thanks, Renee. I can't think of a better topic to kick off this district dialogue series than demystifying inflation, because I've been getting a lot of questions about it. And I would like it to get demystified pretty quickly. I thought what I might actually try to do today is preempt some of the questions that I'm hearing and give a little talk about the questions I get on the topic of inflation and in what I think about them. So I'll give you my perspectives, and as Renee said earlier, these are just mine alone and not those of anybody else. I think, and some of these charts make the point, before I get started, we should just remember that in the decades before the pandemic, inflation was low and inflation was stable, remarkably low and stable. And I'll give my Fed predecessors credit for that. A lot of work went into reducing inflation and stabilizing expectations. But as we saw in Renee's presentation, as each of us is grappling with personally, for the first time in a generation, we're seeing high, broad-based, and persistent inflation. So it's worth asking, what happened? How did we end up in an inflationary environment that most of us wouldn't have imagined even 3 short years ago? So I'll start with what I think is the main story of the past few years, COVID. The pandemic and our responses to the pandemic unleashed a whole series of physical and human supply shocks that have pushed wages up, pushed prices up, and lasted far longer than anyone could have anticipated. On the physical side, when we were locked down, spending shifted from services to goods, especially goods related to time at home. We then reopened with a successful vaccine, and that unleashed demand. Manufacturers were unable to keep up. They struggled to forecast and to operate their complex supply chains. Transportation networks became overwhelmed. Houses were in short supply. On the labor side, we also dealt with supply shocks. Now, at first, the issue was sick or quarantined workers, But the direct health impact was not the only problem. Immigration dropped, child care and elder care responsibilities ballooned, retirements were pulled forward, health fears stuck around. So even once COVID protocols lifted, many businesses still couldn't operate at pre-pandemic capacity. And today, employers are struggling with productivity because they're still trying to train up and get back to normal new workers. I should probably also mention supply shocks not related to the pandemic. The severe winter storm in Texas, the fire at a chip plant in Japan, the ship lodged in the Suez Canal, the bird flu outbreak, and then, in case you were thinking things were too calm, Russia's invasion of Ukraine. Now, in normal times, each might have only had a fleeting impact on inflation, but during COVID, each piled on more price pressure. So supply shocks are clearly part of the story. But for most of us, COVID seems effectively over, and a number of these supply shocks have passed. If supply was the issue, why hasn't inflation started to settle by now? And of course, that's then going to bring us to fiscal policy. So on fiscal, $6 trillion of stimulus was passed, fueling demand and limiting labor supply. $6 trillion is a lot of money. It supported programs like stimulus checks and eviction pauses. It supercharged demand, particularly from the segments of our economy with the highest propensity to consume. The PPP helped keep businesses afloat, but it also sustained worker demand that might otherwise have dropped. And all these programs hit the economy at a time when the supply of goods was effectively and already constrained. So fiscal spending is also part of the story. But while overall demand has recovered, it's not elevated in total versus its pre-pandemic trend. GDP, in fact, is still below that trend. Much of the stimulus still hasn't been spent. Americans still have an estimated $1.4 trillion in excess savings. State and local governments still have billions to tap, and the infrastructure package will take years to roll out. So it's hard to pin inflation entirely on stimulus-fueled demand. Moreover, inflation's global today. There are a lot of other countries that did not pursue the same level of fiscal response we did, but they're dealing with decades-high inflation as well. In the Eurozone, inflation is now at 10.7% versus the mid to high sixes that Renee showed, even though they did much less fiscal than we did. So then I guess we need to turn to monetary policy and look in the mirror. We need to ask whether we'd be witnessing this inflation if the Fed took a different approach. And you won't be surprised to know that I've spent a lot of time considering this question. So some people point to the dramatic increase in the money supply. Since the start of the pandemic, in the context of government deficits and asset purchases, M2, which is a measure we all learned of in college of the US money stock, grew 40%. Milton Friedman famously said that at least in the medium term, inflation is and always and everywhere a monetary phenomenon. So what other proof could we need? Paul Volcker started targeting the money supply in late '79, but he shifted to targeting interest rates instead as a better policy just 3 years later. That's in part because financial innovation has made money velocity less stable and weakened the relationship between money supply, GDP growth, and inflation. You can see the velocity issue during COVID when M2 velocity fell approximately 25%, which is not my definition of stability. In the last recovery, M2 increased 46% between 2010 and 2015, but we saw inflation drop. If money supply were the driving force today, we need to understand why it wasn't back then. So then we turn to the question of whether the Fed was just expansionary for too long. Were we caught off guard after a prior decade of stubbornly low inflation? It's fair to say we believed inflation was temporary, driven by the supply and demand factors I discussed above. History taught us not to overreact to short-lived supply shocks because it usually doesn't make sense to constrain the economy to fight a shock that's going to go away on its own. But inflation didn't go away on its own. With perfect hindsight, it would have made sense to have ended asset purchases earlier and raised rates earlier. But how much faster would we have had to move to be in a demonstrably different place? Sick workers would have still had to stay home. Car manufacturers would still be short chips. Russian oil and Ukrainian wheat supplies would still have been disrupted. So here it's worth emphasizing another Milton Friedman insight, which is that monetary policy works with long and variable lags. Our impact is always more on the medium and long term than it is on the short term. So I take some solace from the fact that medium and long-term expectations have stayed relatively stable, as Renee showed earlier. So if you're exhausted by inflation, like I am, you can point fingers in lots of directions. It's part COVID and part supply imbalances. It's part fiscal and it's part monetary. Movements in any of these factors could have quieted inflation somewhat, but I'm not convinced that any one of them is the whole story. For me, it's the accumulation of so many inflationary pressures at once that likely tells the story. In football terms, we flooded the zone. Now, why do I say that? Well, I look at things based on my background and based on how I spend my time with a real economy lens. I like to spend my time with community leaders like Bill to help me understand how businesses and individuals are experiencing the economy. And what are they telling me? Well, over the last 40 years, inflation stayed so low and so stable that price increases and wage increases became an all but abandoned lever. Price setters lost confidence that they could pass costs on to consumers. They focused on reducing their own costs instead. Firms employed sophisticated purchasing professionals to fight suppliers hard on cost increases. Workers grew to expect annual increases in a low and narrow range. In that era of wage stability and price stability, consumers quite rationally were pretty inattentive to inflation. Now we've seen these intense inflation pressures accumulate and persist. Perhaps magnified in an environment where news travels ever faster, they've moved short-term expectations higher. Massive industry-wide cost pressures push suppliers to take the risk of passing cost increases on to their customers. Supply shortages gave them the confidence they could weather any risk of customer attrition. Purchasers found themselves focused on resiliency rather than efficiency, and they stopped objecting as much. Investors rewarded companies that passed price increases on and penalized those that didn't. Consumers, funded by stimulus, mostly accepted price increases. Workers gained confidence in this very tight labor market and negotiated for flexibility or wage increases. Employers desperately adjusted to do what it took to retain and recruit. In short, businesses that had been constrained by a generation of limited pricing power seized the opportunity when it arose. Workers, emboldened by unprecedented labor market tightness, did the same. Everybody started paying attention. The question then is, how long can this last? Persistence, as Renee said, is the essence of inflation. When I talk to business leaders, they still view their increased pricing power as temporary. They see it as an episode, not a regime change. To support that, with stimulus being drawn down, you hear more and more stories of consumers trading down or doing without. With recession talk widespread, you hear of labor pressures easing. And I do think the number of recent announcements about people bringing folks back to the office, not 1 day, but 2 days, not 2 days, but 3 days, is an indicator of their perception that they have a little more power. So what does all this mean for where inflation's headed? First, no matter what theory you have on inflation, you're seeing promising signs. COVID seems to be moving into the rearview mirror. Supply shocks are easing, with freight costs declining and inventories rebuilding. Employers are having more hiring success. And over the last few months, we've seen the broad range of commodities drop from peak pricing levels. Fiscal stimulus has waned. The projected deficit is expected to fall from 12% of GDP in 2021 to somewhere in the threes this year. And we're seeing the extra savings amassed by consumers being spent down. For those who still monitor the money supply, note that it's started to drop. And the Fed is moving expeditiously. We've raised rates 375 basis points, started shrinking our balance sheet aggressively, and signaled there are more rate increases to come. The transmission of these changes, particularly in interest-sensitive sectors, has been rapid. Look at mortgage rates, which have more than doubled from a year ago. So inflation should come down, but don't expect its drop to be immediate or predictable. We've been through multiple shocks, as I discussed, and significant shocks simply take time to dampen. On the business side, I still hear firms facing wage pressure, especially for merit pay in the face of this year's cost of living pressures. And while margins remain relatively healthy overall, I've heard from many businesses still working to recover costs they've not yet passed through. On the consumer side, while lower income consumers are facing stress, higher income ones are still revenge spending. Our rate and balance sheet moves take time to bring inflation down, but the Fed will persist until they do. One of the key lessons from the 70s was not to declare victory prematurely. Perhaps we will get help from supply chain normalization or energy market normalization. But if we don't, we have the tools to bring inflation down, no matter what disruptions occur. So now the fun part. I'll turn it over to Renee and the panel, who will zoom into how inflation has impacted businesses and households and provide their views on where we're headed. I look forward to hearing what they have to say. This is not a shy panel, so I expect to learn where they're thinking I've got it both right and wrong. And I look forward to your questions later. Thank you very much.
Thanks so much, Tom. And with that, I'd like to call our panel up to the stage. And for those of you who are anxious to ask Tom questions, I promise we're going to rope him back up here for the Q&A portion at the end, so save your questions. So coming to the stage is Kartik Athreya of the Federal Reserve Bank of Richmond, Joanne Shu with the University of Michigan, and Bill Crutchfield with Crutchfield. Come on, have a seat. So Kartik, Joanne, Bill. I think they want you to sit where you're matching your Bill, Joanne. You come here, Bill. Joanne, you can be in the middle.
Okay.
Kartik, you sit there. Come on, be friends with us.
I think we failed our test.
We got it. We got it. We're all good. This is perfect.
The first test, right?
So I'm really excited about this panel tonight. We were really intentional about picking three people that have very different perspectives in terms of where they sit in the economy from their different vantage points. So we've got a researcher and supporter of the policy process, someone who studies the consumer in particular and consumer expectations, and then someone who actually sets prices sometimes, which is Bill. So if you would, maybe please take a moment each to introduce yourselves, then also talk a little bit about what you've experienced in terms of inflation in the last 18 months or more. Would you like to go first, Bill?
I'll start up. Yeah, my name is Bill Crutchfield. I have a company modestly known as Crutchfield. Started 48 years ago in my mother's basement with $1,000 in savings. And we've grown into one of the largest consumer electronic online retailers in the country. We sell about 16,000 different consumer electronic products, from home, car stereo, all the way up to drones. Our experience has been very strange. It's not like so many businesses. We enjoyed phenomenal growth during the pandemic. In fact, our 2021 sales were 70% greater than our 2019 sales. And that was attributable to some of the factors that Tom mentioned. I mean, the retail stores were shut down, but there's just this normal shift, or this rapid shift to online retail from store retail. What would have taken our industry 5 years to accomplish took place in just a few months. So that's a very interesting twist. But one thing, let me bring up for a minute. We have a type of inflation. It's not quite as broad-based as what you're talking about, but this is not reported on very much, but it certainly influenced our sales dramatically in dollar amounts. What happened because of supply chain shortages, mainly in our industry of semiconductors? Manufacturers allocated their precious chips to their higher priced, higher margin products. So what that meant, there was a shortage of the lower priced products. So if people wanted to buy like a home stereo receiver or car unit or even a drone or any of these product camera, they would have to step up to the higher priced products because there just wasn't the availability of lower priced products. And this was pretty much characteristic throughout other industries as well. I mean, it's tickled me when Rolls-Royce had an earnings call and they announced they had no trouble getting chips. Well, Rolls-Royce is owned by BMW, so I'm sure they were allocating chips away from inexpensive BMWs to expensive Rolls-Royces. So that's been a strange thing. Now, of course, we're experiencing inflation, as we all do. There's certain, we have higher cost of shipping, higher cost of packaging, and then we have higher cost of labor that's not necessarily related to productivity. So that's our story.
Great.
Somewhat unique.
Thank you very much. Joanne, how about you?
Hi, everyone. My name is Joanne Shu. I am the director of the surveys of consumers at the University of Michigan. And this is a survey that's been running since 1946, measuring consumer sentiment, meaning how they feel about the economy, where they think it's going, and inflation expectations, which Renee has already spoken about. Over the last year, I think inflation has been my bread and butter at work, understanding what people expect about inflation going forward. But what's also been really interesting is that on our survey, we not only ask people what they think inflation is going to be, but we also ask people, is it a good time to buy large household goods? Is it a good time to buy a house? Is it a good time to sell a house? Is it a good time to buy a car? And over this 1 year period, my car broke down. I sold a house. I bought a house in Michigan, and then had to contemplate buying appliances. So it's been really interesting making these decisions for my own, just as I'm watching all the data come in from American consumers, across the country, telling us all about, what they're feeling, what they're facing, their perception of how much high prices are impacting their pocketbooks, and experiencing it on the consumer side myself.
Do you want to say anything more about how expectations have evolved?
Absolutely. So inflation expectations have obviously increased, or not surprisingly increased over the last year. But what's been really interesting is that long-term expectations haven't actually increased nearly as much as one might have expected. Right now it's been in the 2.9 to 3.1% range for over the last year or so, even as inflation continues to go up. But at the same time, uncertainty over inflation is near an all-time high. Consumers really have a variety of opinions about where inflation is going, and we haven't seen this level of disagreement since the 70s, or since in decades. So even though inflation expectations don't seem out of control, there's a lot of disagreement about where things are going.
Very helpful. Thanks so much. And to level set, the chart I showed was a measure of inflation expectations from the bond market. And as I mentioned, there's many measures, and so asking consumers directly what they expect inflation to be is also very informative for us. So thank you for that. Kartik.
Great. Good evening, everyone. My name is Kartik Athreya. I'm a research economist by training, and I've been at the bank for a couple of decades now. And in the last 8 years or so, I've helped support the policymaking process here at the bank, and helping a team support Tom in his work at the FOMC. Renee, you'd asked about sort of what's kind of struck me about the period that we're in right now. I have to tell you that for the first 15, 18 years of my career, we hadn't experienced inflation that was remotely interesting. I mean, it's a very good time to be working, but it's not one that lends itself to you all the time sensing the urgency of your work on a day-to-day basis. I think the really big change for me personally as an economist, as a Fed employee, has come in the last couple of years saying, hey, we're far away from target. This needs to be dealt with. How are we going to deal with it? Let's think really hard about all of the questions that arise now with the path ahead. And I think for me, this was, we did such a good job for such a long time that it was actually difficult to motivate lots of people to think only about this thing that no one saw happening. So I think in some ways it's bad that it had to take a real world experience to kind of, I think, get me to think harder about something. But, I'll be honest and say that the last couple of years have been a real wake up call for me to be more diligent in the way I'm thinking about that above kind of everything else that I've been thinking about. So I have not experienced the Rolls-Royce inflation problem that Bill has described, but
I second that. So I think when we really started to see inflation rise in the last 18 months, for a lot of people, they automatically think of the 1970s and they say, okay, that's exactly where we are. We're going to see that again. It's out of control. And so I just like each of your perspectives, because again, you have very different perspectives. In what ways does this feel like the 1970s? And in what ways is this pretty different?
All right, I'll start. I may have a unique perspective here because I may be the only one in the room or online who managed a business during the 1970s, so I vividly remember it. I think one way that I feel it could be similar, I do have a concern, and I think this is something we have to consider, is the possibility of stagflation, and hopefully I'll get to that point a little bit later. That would be a way that it is similar. But there are many differences between today and then. Back then in the 70s, we had very erratic policy. In 1971 and 1973, President Nixon put in price controls. Price controls just didn't work, and it was create even more economic mess than they could help. In 74, President Ford created a program called Whip Inflation Now, WIN, and we were to wear badges with WIN on it, and solutions were like plant your own garden in your backyard so you could buy produce, or carpool, set your thermometers at 68 degrees. This was his concept of bringing down the high inflation. Well, that didn't work. I think it was Alan Greenspan who later said the program was idiotic. But the Federal Reserve also was guilty here, and Tom alluded to this point because they followed a stop-and-go policy on monetary remedies. And if I'm not mistaken, I think there were 3 stop-and-goes. I mean, where the Fed would step on the brakes a little bit, raise the Fed funds rate, then whether it's political pressure or whatever it was, they would then loosen again, and inflation would come back. Then they would step on the brakes again, Fed funds rate loose. So we went through 3 of these cycles, these stop-and-go cycles, and the Fed lost credibility, people lost credibility in what the government was doing, and it was a very tough time. It wasn't until Volcker came in 79, and then I think in 80, he really stepped on the brakes and drove the Fed funds rate way up, and it finally broke the back of inflation. We're not going to have that now. I don't think anybody thinks that inflation's not that high. The Federal Reserve has learned mistakes of the 70s, and they're certainly not going to repeat that. So I don't think that's going to be an issue.
So when people talk about, is our current inflationary environment like the 70s, I think what's often lost is that the 70s was an entire decade. And inflation, as you were saying, Bill, it follows several cycles. And no, I don't think we're in the situation that in the second stop and go or the third stop and go, but we are potentially at that first go. If we look at the inflation numbers that Renee put up, our run up in inflation is actually steeper than it was the first time in the 70s inflation episode. And so I think that there are a lot of risks ahead of us. I don't think we are inevitably going into a 70s decade type situation, but the risks are still there. One thing that's come up a lot in the conversation, including a number of Fed speeches, is are inflationary expectations entrenched? The survey that I run has some questions that addresses that. We collect information about whether or not people think it's a good time to buy large things, cars, houses, appliances in advance, buy things now to avoid higher prices in the future. And when people believe that it's better to buy things now, that is something that would apply extra upward pressure on inflation and could add to this self-fulfilling prophecy because people have entrenched inflationary expectations into their minds. And as it turns out, right now, we don't actually have a lot of people who subscribe to this buy in advance psychology. It's still at fairly low levels right now, but that doesn't mean it can't rise in the future. We're only a year and a half in, and well, it doesn't feel like only, but if we're comparing to the 70s entire decade, we're only a year and a half in. So we're definitely not out of the woods, but we are not fully in the depths of it from a psychological standpoint at the moment.
Thanks so much. And I think we're going to come back to expectations in a minute, because it's a really important point to really understand in terms of the evolution of inflation. So Kartik, what would you add?
Yeah, I mean, I would agree with what my previous panelists have just said. I would emphasize from my viewpoint as an economist, a couple of things. One of them is, I think, starting in the 70s and then going through the 80s, the economics profession also became much more aware of the need to think about the fact that everybody in the economy looks forward in their own decision making, and really impounding that in the way we think about the models that we would write down to guide our own intuitions about what's happening is something that I think really took hold in the 70s and then in the 80s and then beyond. So one really concrete way of thinking about this is that we tend to think, and Tom mentioned this in his remarks tonight, we tend to talk about policy a lot. And when we talk about policy, we don't mean what did we do today? We don't mean what will we do just tomorrow. There's a much more clear expression of how we will act now and how we will act in the future depending on what happens. So we've seen various versions of this. If you look back at the chair's statements, if you look back at the FOMC member statements, there's a much greater cognizance or acceptance of the idea that what people need is to understand the rule that you're operating by as a policymaker in order to make your own decisions. And certainly the business community has to think about the Fed not as doing things spasmodically, episodically, but rather as part of something much more systematic. One thing that's really helped us be systematic that I guess to me really is decisively different than the 1970s is that we have an inflation target. There's something very deeply focal that the audience here and online does not have to wake up and think, I wonder what these people mean when they say we're going to return inflation to target. There wasn't such a thing, that was really codified in a decisive way. This basic, focal tool that we now have allows the policymakers on the FOMC to speak with one voice. And I think that's the other point that I would draw your attention to, the unity in terms of the way that FOMC members, despite perhaps variations in the way that they process what's happening at any moment in the economy, the unity in terms of saying inflation is a problem, we're on course to get it taken care of. That's something that I think, if I went back and looked at the transcripts, let's say, of that period, I doubt that I would see this level of clarity in terms of unity of purpose and really something focal like a target.
Great, that's really helpful. So let's talk a little bit more about expectations for a moment. And again, it's really important to understand this because expectations are really central to how we think about how inflation might move in the future. And so I'm going to ask this question in 3 parts. Kartik, how does the economics profession think about inflation expectations, and in particular, how the Fed uses inflation expectations in the setting of policy? And then Joanne, maybe about how consumers are feeling about future inflation now, if you've got more to add on the long-term picture that you mentioned, and how has it shaped their behavior? And then Bill, what do you think businesses are expecting now in terms of inflation, given where we've been? So Kartik, if I could start with you.
Sure, that's good, because I would have forgotten it had we waited for all 3 to go.
I can remind you.
I think, it's important to, again, double down on what I said a moment ago, which is that once we started taking as a profession the future seriously as part of what people think about and businesses think about, the immediate question that you have to answer is, well, how do they form expectations about what's happening in the future? So I'm going to give you some good news and some bad news. So the bad news is that we don't see expectations in a utterly crystal clear way that we know. We cannot look into people's heads. We have to do inference of the kind that Joanne can speak much more clearly about. So we need to learn some way, somehow, what people are thinking. In our models, we often have to resort to something that says, well, if people understood what we were trying to do, then here's what a reasonable view of what inflation should be is, okay? So that's basically us backing out what a reasonable view ought to be if people understand what we're up to. So that's not wholly satisfactory, right? Because we don't know that people understand exactly what we're up to, but we're sort of also stuck by the reality that we cannot peer into people's heads in a very decisive way. So that's like, one thing. The second thing is, you might call it belt and suspenders if you want. That's a very old-timey thing to use. I don't know why it popped into my head. But you can think, okay, that's fine. That's some guidance as to what expectations are doing. But then I do think that this leads directly into the kinds of things that Joanne thinks harder about, which is, let's actually ask people, and then let's think really carefully about what they're saying, and then see how that tracks, and then validate that carefully. And then you have the third, suspender perhaps, of looking at market expectations. So Renee talked about bond market implied expectations on the slide earlier. That's useful for us because economists are skeptical notoriously, and so people say a lot of things, but we think, well, people say a lot of things, so what? Let's look at what they do when they trade and the kind of premium that they demand for protection against inflation in the marketplace when skin is in the game, when money's on the line. And so between these 3 objects, we get, I think, some clarity on inflation expectations.
That's great. And I'll repeat the question for the benefit since it's been an hour. So Joanne, how are consumers feeling about inflation, future inflation now? And in particular, how do we see it affecting their behavior and their choices? Because that, of course, affects the macroeconomy in a big way.
So while it may be true that we can't open up people's brains and find out where their expectations come from, I don't think there's any better way to find out what people are thinking than to just ask them. And that's exactly what we do on the survey. And we don't just ask about inflation expectations, where people think inflation is going in the future. We also ask them about where they think their personal finances are going, where the macro economy is going, how housing markets are going to go, where interest rates are going. And so we can get kind of a full picture of a range of things that we believe that people might be taking into account when they are making spending decisions, not just now, but planning their spending decisions in the future. I mentioned that this survey was started in 1946, which means we have decades and many, many business cycles of data to look at. And what history has shown is that when consumer sentiment, kind of their expectations over their assessment of their current personal financial situation and the economy and their expectations going forward, when consumer sentiment is low, it tends to precede an economic downturn. We have seen inflation expectations are actually quite highly predictive of changes in CPI and actual inflation. They're not perfect. Like I said, people disagree, but on average, the expectations are quite powerful. Consumers are even though the typical consumer might not be paying that much attention to Fed policy, when we ask them, do you think interest rates are going to rise in the year ahead? It's actually not predictive, but it's quite accurate, actually. And so, even though a lot of people like to think about, talk about consumers, like, is this really translating into behavior? Well, it's certainly translating macroeconomically. And so I think that's pretty powerful evidence. In terms of what we're seeing today, I mentioned that inflation expectations are absolutely elevated, but they're not nearly as high as one might fear. The interesting thing is that, consistent with the data you were showing on real incomes, most people, by and large, expect their nominal incomes to increase, but very few expect them to outpace inflation. People are generally expecting real wage declines over the year ahead. So that is another kind of piece of the puzzle of, are we going to be in a wage price spiral? I'm sure consumers would love if their incomes could outstrip inflation, but that's not what they're expecting.
Bill, go ahead.
All right.
Did you repeat the question?
You
It's
can
been a
repeat
while. So what do you see businesses expecting now in terms of inflation? And that could be from your own perspective or what you see peers doing. How are they managing around inflation now?
Well, I think all businesses expect inflation. The question is, will it be a short-term, mid-term, or long-term? So that's it. But how they're managing it around, the successful business people will do what they've always done, and they will learn to manage through this process. Several things that they will have to get their arms around. One, they'll gain a new respect for excessive debt and corporate profitability. Cheap money for a long period of time may not return for quite a while. And we need to model our businesses around more expensive debt. This will be something that, in order to survive, I think all businesses will have to do. Some companies that are dependent on extremely high leverage and the lack of profitability are basically zombies. I mean, they're walking, but they're dead, and they won't be around after a few years. The 1970s was a great learning experience for me in particular. I mean, it was a terrifying time to start a business and to grow a business when interest rates, I think the prime got up close to 20%. It was very, very difficult to get financing. So it taught me to be very debt adverse. And I built a business around a model that does not require debt or outside investment. So right now we have no debt, we have cash, and I'm still the sole stockholder. But it was that experience during the 1970s that really inculcated that philosophy in my mind. And I think as we go, depending on how bad this gets, other business people, particularly people starting out in business, will have to think the same way. But there's something new that's coming around that business people will have to learn to manage. This is completely new as a result of the pandemic. We need to understand and better manage remote worker productivity. That's something we're all kind of clueless about now. We're living in this new world of hybrid work. There's no practice playbook on how you manage this process, whether people come back 2 days a week, 3 days a week, or 5 days a week. Along with it, we must promote better on-site work. And this is going to be tricky. It's something we're doing in our company. We're trying to come up with creative ways to bring people back to work. Some jobs can be performed remotely, but a lot cannot. It's critical for fostering collaboration, for mentoring new employees, and for inculcating culture to have them in the office. We've hired several hundred people during the pandemic, and some have never laid foot in our offices. They will never get what makes Crutchfield so unique, if that's the case. And I think this will become one of the biggest issues for managers and executives in this decade going forward.
So we talked a lot about wages, and I want to linger on that for just a minute. So you mentioned that consumers don't expect real wages to keep up, which is somewhat depressing. Are we in a wage price spiral? And again, that's this sort of situation where wages drive inflation and inflation drives wages, and it's harder to contain both. Is that the situation we're in? And if not, what would that start to look like? It's a question for anybody.
Okay, I can take a stab at it. So I would say, no, that's not the situation that we find ourselves in. I think, one thing that to me is important is the expectations numbers that we've shown. If indeed this was where everybody think we were headed, it would be very hard for me to square it with the data that you showed. It'd be hard to square it for me with what Joanne talked about, people believing about the future, and what we're hearing from the business community more generally. But it does instantly, I think, make sure that we ask the second question, which is, well, what are you doing on the policy side to make sure that that's not the thing to expect? And I think here I'll go back to the chorus of voices from the FOMC, starting with the chair, on cognizance of the need to deal with inflation and resoluteness in terms of needing to have policy where it is in order to get it back under control. So for me, I do think that what we're seeing right now is entirely consistent with this period abating over the next 18 months or so, and then getting us back to target. That is my base case view of the world, and I see enough surrounding evidence to say that no, we're not in that period, even though right now we have seen both wages and prices rise higher than they usually do.
How about you, Joan? Would you add anything to that in terms of how consumers expect that to evolve in the future?
I mean, as I mentioned, consumers by and large don't expect real wage increases over the next year. So, I would say the evidence I see is that we are not in a wage price spiral yet. But I think it's still a possibility in the future. At the same time, though, I mean, this is just such a tricky situation for consumers because it might be better for the economy for their wages not to rise. But that just doubly increases the pain that consumers are in as a result of inflation. We have the highest share of consumers, about half of consumers spontaneously telling us about how high inflation has eroded their living standards. I mean, that we've never seen that before on the survey. And consumers are really hurting. And so I think it is a very bitter pill for them to swallow for anyone to tell them, you need to sustain real wage declines in order to get inflation under control.
So Bill, from a business person's perspective, how does wage growth feel to you? What does wage growth look like for you at your firm? And what do you think is going to happen over the next 6 months?
Well, I think we all agree we're not in a wage price spiral right now. I think these things take time. And we've been through a very unusual period the last couple of years with the pandemic and with all these really unprecedented shocks to the economy. So, I think that people's minds are just not, what's happening, the aberrations that are taking place with certain massive wage increases may be more related to this unusual shock to the economy as opposed to an ongoing spiraling event. Also, as far as the labor supply, I think that's going to be normalized with higher unemployment rates, and that's coming. So that'll certainly free up the labor problem. Then there's the great fear of recession. We hear this on the news almost every night that we're in a recession, we're about to go into a recession. And employers are being more concerned about their profitability, knowing if we're going into a recession. And workers are somewhat afraid of being laid off in a recession. So consequently, they're going to be far less aggressive. Also, to my knowledge, I may be wrong on this, but the only really tough labor contract negotiation going on is the railroad unions. And next year, there are going to be some big ones. Often the railroad or the union contract negotiations can start somewhat of a wage spiral. And the union negotiations are somewhat like our canary in the coal mine as far as wage price. And so we need to watch that if we want to see early warning signs. And next year, there are going to be some big ones, as I mentioned, and they build in cost of living adjustments. So if they get some very generous union agreements with big labor groups, that could start the cycle of wage price spiral.
So Renee, is it okay if I just add,
Absolutely.
listening to both Joanne and Bill talk just now, I think even in the instance where, let's say, we observe the wage negotiations in some sectors move, to my taste, that just puts the ball back in the court of the Fed, which is you still don't have to acquiesce at that point and allow inflation to continue unabated. It still remains in the hands of the central bank. And I think this is all the economics that we understand suggest that it would still remain in the hands of the central bank. Now, one thing we haven't touched on, I think, and maybe we'll get to this later, is there's a really important angle here having to do with uncertainty. I think you mentioned it, Joanne, earlier. I think it's, for me, what is really bad about inflation is when it is volatile in a way that we cannot really understand that well. That's when it's maximally disruptive to everybody's way of living. You don't know what the prices are going to be. You don't know what wages to ask for. You don't know what investments to make. It's massively disruptive to daily life. Just to make that clear, imagine that we lived in a world where prices increased at 6% a year without fail, wages increased at 5% or 6% a year without fail. I'm here to tell you that that's not something that would create a national calamity. It's not something that would stress you out that much. And you know this because there are plenty of countries that kind of bubble along at that. So the issue is more, for us with a 2% target, if we have 5% inflation, then you start asking questions about, well, what regime are we in? Are we committed? Are we going to go back? When are we going to go back? How hard is it going to be when we go back? So that can gets opened, and it's less about the inflation rate that is super well understood and super predictable than it is about deviations from what, in this case, the Fed and other central banks in the world have announced as their target. That's, I think, a really central thing for us to keep in our mind about why this is really stressful for all of us.
Well, so building on that, let's get down to it. And this is maybe what people here came for tonight. What is it going to take to bring inflation down? And what are the risks? And are certain groups affected more than others? And who's most at risk as we approach this? Any thoughts?
Well, it's odd. I mean, we mentioned this before. The people who are most effective are at the lower end of the income ladder. And many of these people are suffering very seriously. Your surveys are showing that. You know, the people are taking out second jobs just to make ends meet. They're cutting back on buying all but the necessities. So they're clearly the sufferers of it. The higher income group people, it's somewhat of an annoyance, but it's not changing our quality of life at all. So what's it going to take to stop it? What's the second part of that? What's it going to take to stop it?
Right, and what are the risks? What are the risks as, the Fed acts to bring inflation down? What should we expect to see?
Well, I think to stop it, I'm a great supporter of what the Fed is now doing, because again, I've lived through the 70s. I saw the stop and go and all the policy mistakes that were made then. Clearly, setting a target of a 2% inflation rate and doing what it takes, being aggressive and communicating that clearly, that's very, very important, because when there strange signals going out and Wall Street, the stock markets or the equity markets are reacting to all the misinformation and the conflicting information that's coming out about this. It's bizarre. A few weeks ago, the markets were rallying because they thought inflation had peaked and the Fed was about to pivot. Well, when they found out the Fed wasn't going to pivot, the markets went down. So you have all of this irrational reaction to it. But I think the most important thing is what they're doing, and that is being absolutely consistent and firm on fighting this until they get inflation down and doing whatever it takes to get it down.
And Joanne, maybe you can comment on, how is inflation hitting across different groups of people, different segments of the population, high income versus low income? What do you see in the surveys and what does it tell you?
So what we see in the survey is, it will be of no surprise that lower income families are hit the hardest by inflation. But it's actually a bit of a mixed bag, because the income gains that we've seen over the last year have primarily actually been enjoyed by people at the bottom of the income distribution. So what we're actually seeing in the last couple of months is that while consumer sentiment is near historic lows, it reached historic lows in June since we started measuring it regularly in the 1950s. But since then, the lower income distribution or the lower income families have improved, whereas higher income families, their sentiment has continued to fall. And the reason for this is that even though higher income consumers have more income and have more wealth to weather these periods of high inflation, they're seeing their wealth change a lot with the stock market. And, the stock market was quite volatile earlier in this year, but it's, if you look at now versus the beginning of the year, it's fallen quite a bit. And so this isn't something that lower income consumers are particularly concerned about. They're not very exposed to the stock market at all. But higher income consumers are getting kind of the double whammy. Maybe this first whammy is not that bad for them because they have buffer, but both the high inflation as well as the volatile stock market. And this, economically speaking, for the macroeconomy is quite dangerous because consumer spending is 70% of GDP, and higher income consumers generate the lion's share of consumption. So if they decide to pull back, if they feel less comfortable purchasing, and we're in record low, worst time to buy a house, and houses are being bought, and the consumption that's associated with that, it could exacerbate any sort of economic downturn that is coming up.
I want to add something to what you're saying as far as the wealth effect of the markets. But just before I left Charlottesville a few hours ago, it was reported on CNBC that American homeowners have lost $1.5 trillion in equity value since May. So that has an enormous impact on the wealth effect.
Absolutely.
So
stock markets and housing markets.
Stock market is down to what, 24% this year, and then with housing off $1.5 trillion. This has a big impact.
So even though their well-being might not be that affected, it can have consequences for the macroeconomy because of the spending that they generate.
Kartik, anything you want to add?
If we look at the summary of economic projections that the FOMC releases 4 times a year, you can see what policymakers view as the appropriate path for rates, as well as what they view as the outlook for GDP and for inflation and unemployment. And there, I think it's become fairly clear that there's a view across the research teams in the Fed system that the current trajectory of policy, as seen through the eyes of the policymakers, is something that is going to put the Fed very much on track to delivering inflation back to target. So for me, that's an important piece of aggregate thinking that has been brought in, and it's competitive enough within the Fed system that I don't think it's everybody just thinking the same thing because they want to fit in. That's not the world that I feel like I inhabit, and so hopefully that is also a source of comfort.
All right, thanks so much. And so I'm going to ask the panelists one more question before we turn to audience questions. As a reminder, if you're online, feel free to enter questions into the chat. Be thinking about your questions here. So, Tom mentioned this phrase by Milton Friedman that inflation is always and everywhere a monetary phenomenon. But then you hear about things like the war in Ukraine and energy price spikes and even, wages to some extent. To what extent are there factors outside of the Fed's control in managing this going forward? And to what extent does that mean the Fed's powerless?
Want me to start?
Little irony in the question, yes, go ahead.
Okay. Now, this is something I've done a great deal of thought about because, again, for about the third time, I lived through the 70s. I understand what stagflation feels like, what caused it then. And I do see signs of potential stagflation occurring here because there's certain inflators in our economy that the Fed has no control of. Raising the Fed funds rate, all the tools in the toolbox will not address. And I wrote some notes down here. One, wages, they're pretty sticky. Wage increases are sticky. It's hard to reverse it. But on the other hand, it's easy to reverse the rate of increase. That's not a big concern to me because this will be self-correcting when the recession comes and wages will stabilize. But here are the big ones that I see are the deflators that are beyond the Fed's control. It's a little scary. One is deglobalization, or some people call it reshoring. Globalization over the last 40 years was responsible for keeping inflation low. We outsourced our manufacturing to China, so products were cheaper coming into this country. But that's changing, and that's changing because of the supply chain problems we have as a result of the pandemic. Now we have geopolitical problems, particularly with China. Russia was never really a factor in trade, but China is an enormous factor in trade. And, you look at semiconductors, I brought that up earlier, but General Motors, up until recently, had 100,000 vehicles sitting in lots around the country. They were finished vehicles, cars and trucks, but they may have been missing one small electronic component because they didn't have a chip or two to go in those components. Those components were coming from China. and our offshore. Mary Barra, the CEO of General Motors, would much rather pay a lot more for chips from a reliable source and get those 100,000 cars out to the dealers and to customers. So we will be onsourcing, we will be deglobalizing, and we'll be paying more for it. That is a factor of inflation that is inevitable, and the Fed can't do anything about that. In fact, I don't think the Fed wants to do anything about that because that's to the benefit of our economy in the long run, not to be plagued with these supply chain problems. The second factor that concerns me is energy. Now, we tend to think of the metric for high energy and low energy as what we pay at the gas pump, but that's just a tiny, tiny part of it. Fuel prices oil will start going up. At some point, we've got to stop pulling reserves from the Strategic Petroleum Reserve, oil from that. And we also have to start refilling it. I mean, it's the lowest level it's been since the early 80s. That'll drive world oil prices up. When the EU sanctions seaborne imports of Russian oil on December 5th, that will create a pressure on oil pricing. And then when China lifts its COVID lockdowns, its oil demand will increase. Again, that will impact world oil markets. Part of this energy is distillates. These are a big factor that we tend to overlook, and the media pays very little attention to it. Distillates are a form of energy that include diesel, jet fuel, and heating oil. A few other things too, but they're the big ones. Home heating oil prices this fall are forecast to go up 10% across the country. I heard on CNBC in the car today that in New England, they're cool top, I think it was 31% is what they expect for home oil prices to increase this fall. The supply problem is critical. Our inventory of distillates is at a 40-year low. And 40 years ago, we had 100 million fewer people living here. I just heard today on the radio that Boston only has 12 days of diesel stock inventory. And if they run out of diesel fuel in the Boston area, think of the catastrophic consequences to that economy. A major part of that problem is the fact that we've closed 6 refineries in the last few years. And you can't restart refineries very easily. And then prior to the war, we were importing distillates from Russia. So obviously that's gone away. Of course, all of this is very inflationary. And in our company, we're seeing it across the board with UPS rate increases, mostly driven by diesel prices. Electric bills are up 50% in some regions. This is due to 2 factors, really. First, the input cost of natural gas, oil, and coal to power generation plants has increased enormously. And don't forget, 60% of our power comes from fossil fuels. Second, the drought in the Southwest. It's a 1,200-year drought. Some hydroelectric plants are just too low to generate electricity. Even the Hoover Dam is producing 25% less electricity than it should be. The Fed can't influence those factors. Another big driver of inflation that could drive stagflation is food production. Russia was a major producer of fertilizer. With its sanction, prices have gone way up. Also, natural gas is used in the manufacture of ammonia, and ammonia is a critical ingredient of fertilizer. As these prices have increased, farmers have had to fertilize less, and when they do that, they have a lesser of a crop yield, and that drives up pricing. Due to the drought in the West and Southwest, the government is reducing water for crop irrigation in some critical areas like Arizona. It will get into California soon. And as Tom mentioned, Hurricane Ian was devastating to Florida. The Mississippi River is at its 70-year low. Barge rates for food have increased 4-fold this year. All of that's inflationary. And then Putin is still threatening to cut off the grain deal that they brokered a while back. The Fed can't influence these factors. Then there's, of course, shelter. And this, I'll close with this. At the core of the problem remains our nation's tremendous demand for shelter. We currently have 5.5 million fewer homes than people need in this country. This has driven up pricing for both homes and apartments. We can't be relieved by the talk of falling home prices because the real cost of shelter, particularly for home ownership, is not the sticker price of the house. It's the monthly mortgage payment. I read something in the paper the other day that the median price of a home in the U.S. is $394,000. And if a mortgage, and it was alluded to earlier, that mortgage rates have more than doubled from about 3% to a little over 7% in the last year. that house, if it were financed or mortgage was originated today, it would be $1,000 a month more than had it been originated a year ago on the same value of house. So that's a huge problem. It's just pricing a lot of people. As people are priced out of the housing market, they have to go into apartments. That puts pressure on markets, on rental income. And so basically, if the Fed continues to raise the Fed funds rate, that's going to exacerbate that problem even more. So without sounding too pessimistic, hopefully we'll get through all this without stagflation. I don't mean to be the prophet of doom here, but on the other hand, these are factors that we all have to consider, that the Fed doesn't have everything in its toolbox to deal with all of these calamities that are affecting the world right now.
So maybe
be prepared, be prepared.
It's Tom, if you want to make your way up to the stage, Kartik, what would you say about the Fed's control over inflation given some of those forces?
So secretly, I was delighted because I felt like I was getting the greatest get out of jail free card, which is none of this is your problem. Don't worry about it. That's the only thing that I heard from this, other than we're all going to die. But I tuned the second part out. But I think it's really important to add a additional condition to what Bill just listed, because every one of those things in the face of a monetary policy that is not appropriately tuned, I think will do exactly the things that Bill is worried about. If we are cognizant of the shifts that are happening in the world, then it falls right back, in my view, to the central banking systems of the world to set properly the policy. And one concrete example of this is that durable goods prices for, let's say, 30 years or so, we were talking about China earlier, they've been experiencing deflation. They've been getting cheaper and cheaper. Quality adjusted, products like your phones, TVs, durables, they're all dropping at the same time that you've got things like services and so on rising. So we got deflation in some parts of the economy, inflation in other parts, but nothing at all happening at the level of headline inflation, which is the thing that we're on the hook for. So you can have systematic changes in real forces that are prying apart the relative price of services compared to TVs, for instance, and have that have nothing to do with inflation at all, so long as you understand that these forces are actually happening. In periods of flux, like Tom, your opening remarks, I think, and the period that we're in right now is unusually riddled with things that are happening all the time that are new and in flux. And it's, I think, I'll defer to Tom on this, but it's substantially harder to understand exactly how to calibrate what the posture is. But I don't think any of this obviates the fact that the Fed is ultimately, or the central banks of the world, ultimately own any kind of sustained inflation.
Okay. Thanks, Kartik. So we have just a few minutes left, but I want to make sure we hear some of our questions from the audience. So let's start with the question inside. And please be entering your questions in the chat as well if you're online. I see one down here. One here. I don't think so.
So I'm a very practical person. I run a school division in the area, and I need to know how much inflation I should expect for both capital projects, construction, and just normal operating expenses.
In what time period?
Next year would be great.
According to the PCE or the CPI? I was just kidding.
Nobody take a stab at that.
I'll gladly accept it. I mean, the answer is it's not a point estimate. There are elements of inflation that I think are going to settle over the next year. Commodity prices have already started. Supply chains we talked about. Chips are getting into cars. Used car prices are going to come down. Wages are still up. That's driving another set of prices up. And so I think there's a wide range of estimates. The best estimate I would have, if you look at my colleagues, they predicted about 6 weeks ago what they thought it would be next year. And I think the median was in the low threes. But, there's a confidence interval around that that's significant. And I think this is like trying to predict the stock market. If anyone tells you they have the number, they don't.
Any other thoughts? Another question?
While we're waiting, can I be more optimistic than Tom?
Please.
If you stretched it out a couple of years, depending on the capital, the lifetime of the projects you're thinking about, I do think that these point estimates start becoming less all over, all over the place. And so 2 to 3 year horizons, they look tighter to me anyway. So Tom, you're free to rebut that, but.
No, and I was going to say, I was really glad Renee didn't ask me, am I with Bill or am I with Kartik on this? Because there was a pretty big bid-ask spread there. But I think the source of the difference is that monetary policy doesn't control tomorrow's inflation. It controls inflation over the medium term. And I think over the medium term, I may be wrong, but both Bill and Kartik would say, oh yeah, inflation is going to get under control as a lot of these one-time factors go away and as monetary policy gets set to try to control it. In the short term, though, lots of these one-time factors really do have an impact on inflation. That's how I would.
Yeah, I agree.
That's how I'd square that circle.
My question is for Tom Barkin. I heard Kartik say that a target was important. I heard Bill Crutchfield talk about the need for the central bank to be consistent and resolute. And that triggered my question, and that is I was watching Chairman Powell's press conference last Tuesday, and he launched into a monologue that lasted several minutes, where he was trying to explain what might happen with future rate increases. And I didn't understand what he said. And I backed up my DVR and I watched it a second time. I'm sorry?
I was teasing. Mission accomplished.
Well, maybe so. Anyway, I backed up the DVR. I watched it a second time, still didn't understand it. And after the third attempt, I decided I needed somebody to demystify. And so since that's the topic tonight, maybe you can explain what he was trying to tell everybody.
Well, I guess the simple way I could put it is that if you wake up last spring, rates were basically at zero, which is a lot of stimulus in the economy. Inflation was high, persistent, and broad-based, and we needed to move as fast as we possibly could, with the constraint being let's not try to break anything along the way. And so over the last 6 months, we've moved very fast by historic standards. And so today we're at a place where credibly you can say real rates are positive. And what I mean by that is that the rates at any point in the curve are higher than the rate of expected inflation, at least as judged by the markets. And if that's the case, then you are now constraining the economy. Your foot's no longer on the gas, you're on the brake. I think if your foot's on the brake, you don't have to move quite as fast, right? You might even pump the brakes as you go. So I think what he was saying is we're open to a slower pace that might last somewhat longer and might actually end up being a little bit higher, but isn't going to be the same rapid pace we've been on. The current rates are current rates 3.8. I said forward-looking inflation metrics. By our metric, inflation historic last year has been 6.5, but I'm not sure how relevant that is, right? If you look at the one-year CPI swap, it's at about 3.2. If you look at TIPS indices, they'd be in the high 2s. And so you have to look forward on inflation. Looking backward doesn't help you. You have to look forward.
I think we've got a question online.
What method will the Fed use to determine if it has overcorrected?
Oh.
I don't know if I get all the questions. You
Yeah,
can take this one.
I'm happy to take that one, I guess. So the question is, what metric indicates that we have overcorrected? I want to make sure I understand.
Well, yeah, so with inflation lagging interest rate hikes, what method will the Fed use to determine if they have overcorrected?
Well, I think, one of the things that'll have to be seen is how rapidly inflation comes back down. I mean, that's right now, we're at a period of 3.7% unemployment that is extremely low by historical standards. 4% is seen as some sort of long run low that you could typically stay at. We've got inflation at 6%. So, I think the overcorrection would have to be an indication that somehow inflation dropped very rapidly at an extraordinary cost on the unemployment side that led you to believe, this was too rapid, too quick, too harsh. I think right now, even though we've telegraphed, or the Federal Open Market Committee has really telegraphed the way in which it's thinking about policy along lines that Tom just described, that we're moving, we're resolute. And so that is all aimed clearly to avoid the incident that the question poses, which is if people don't know, then the possibility of overcorrecting is much greater. I think if people understand what we're up to, then I think that gets much less of a risk. And I don't think that's, front and center at the moment.
Questions down front?
So thank you, panelists and Mr. President. First off, I wanted to ask, so it was spoken about earlier that there exists a range where interest rates can sit without being overly restrictive or encouraging to the economy. And the Fed is tasked with keeping it at around 2%. But some people argue that it would be possible to hold, it would be possible to hold inflation at a higher rate than 2%, not necessarily at that point, without overly damaging the economy, and point to other countries that are capable of doing so and do so regularly. What would you say to that? And is that feasible for the US, notwithstanding that deviating from the target would be a very big problem for the Fed?
So I actually want to ask if, Joanne, you want to say anything about expectations management in that kind of a world? Because I think your question bears on what people are led to think about what the regime is.
Yeah, I mean, I think that if we're living in a world where long-term inflation is expected to be at 3%, whether or not the economy can sustain it is going to depend on what consumers and what businesses are going to do, and how those decisions interact. So, I mean, currently our situation is that our supply and demand are completely out of balance, and I mean, it could be at 3% in inflation. That things could be in balance, but it's not an environment that we've seen in a sustained way in this country, so it's kind of hard to predict. We've been in a super low inflationary environment since the Great Recession, and consumers are really used to that. And so if policymakers were to communicate that we're not going back to that anymore, we're never going back to that, it could lead to disruptions in people's decision making. I mean, we're already seeing that in housing markets and lending markets, where interest rates have gone up so much over the course of this year. What a lot of people forget is that historically speaking, 6-7% mortgage rates are perfectly normal. But for someone like me who came of age in the Great Recession is completely unthinkable. The current interest rates are completely unthinkable, whereas my parents are just roll their eyes at me. And so I think it's a difficult thought experiment, because it depends on what consumers and businesses are going to do, and the majority of consumers out there have no idea what that looks like.
I mean, you could operate at 4%, you could get to 4%, but I wouldn't forget that we've had an unbelievably prosperous last 30 years at 2%. And so the business case for 2% is pretty strong. The business case to do something different doesn't feel very strong at all.
I think we probably have time. Oh, Kartik, go
I
ahead.
was going to just to double down on that. I mean, if we looked at the sort of more formalized target that the Fed has adopted, my look at the time series that Renee showed us earlier kind of says that, okay, we got here. This is kind of working out pretty well, exactly to Tom's point. And then you say, okay, this would be a good place to stick around at. It wasn't that we were in 8% all the time, and then somebody said, let's go to 2. Those switches, I think, are very difficult to communicate and make stick. In the end, this is to demystify inflation. I want to make the point that we're sort of in the weights and measures business, right? So if I told you tomorrow we're going to measure everybody's weight in kilograms instead of pounds, what are you going to say? You're going to say, well, that's not particularly disruptive. In the U.S., it's very disruptive. We cannot handle that clearly. But more generally, you're not going to find that too disruptive if everybody gets the units that we're going to use one day to the next. The case for something closer to 2% or something closer to price stability is that you want to vacuum clean out people wondering, what units are we going to use today? Because that does matter for the kinds of prices that Bill ends up having to set and figure out, how to survive in a business. And so, that's another argument for not wanting to tinker with the target.
I think we've got time for about one more question before we go to closing remarks from the panelists.
There used to be a definition of a recession with 2 quarters of negative growth. Then that definition seemed to go away. People say we're in a recession, and I've heard we're not in a recession. For the economists here, is there a new definition, or are we in a recession? What's our status?
Wikipedia has actually suspended editing on the recession page because there's so many different people with different agendas trying to make the point. So I'll say the following, which is there's actually a recession committee out there that's named that decides about 2 years from now whether we were in a recession or not. They use 6 or 7 metrics, which would include growth, but would include, employment and job loss, industrial production, and a bunch of other things. I suspect when they look at this year and they look at September 30th, which is where we've got the most recent data, they're going to say we're not yet in a recession. The job growth has been extraordinary. If you're in a recession, a lot of the GDP negative was actually one-time things, trade and inventories, that actually started to reverse. I do think there's a risk we're headed toward one, though. And what I keep saying is that most of the firms I talk to have got their recession playbook out. They've updated it. They may have even taken a couple things off page 1, like doing a hiring freeze or cutting off advertising. Most of them, with the exception of those in the construction business, haven't moved to page 5 yet, right? But that's the risk, is that something happens external, something happens internal that causes a lot of people to do that. And when they do that, this committee will actually come back 2 or 3 years from now and tell us the precise answer.
So we're approaching the end of our time here, but I wanted to give each of the panelists a moment to say, what are 1 or 2 things you hope the audience takes away from this discussion, and maybe in particular, what gives you hope? And so, Bill, I'd like to start with you.
I've been pessimistic, but on the other hand, in the long run, I am optimistic. I think we will get this straight. I think we have an excellent central bank in this country. They know what they're doing, but we have to be cognizant of the fact that we're living in very unusual times. Things have happened in the last few years that have never happened in the modern history of our country, or the world for that matter. So therefore, I think Tom's point about going to page 5 of the playbook is pretty good advice. I know if you prepare for the worst and hope for the best, you won't be out anything if the worst doesn't come. But if you don't prepare for the worst, or even for a bad situation, and it does get bad, you could be in very serious trouble. So that would be my very simple advice for the evening.
Thank you. Joanne?
I think I want to bring the thoughts of the consumers to the room, and consumers are really undergoing uncertain times. If those of you who are in this room who are really interested in the economy and are following the economy are here to be demystified, so is the average consumer. Consumers are in a lot of pain right now, but at the same time, they are enjoying income growth. They're not seeing real income growth, but the fact that labor markets are strong and the fact that there is savings from earlier in the pandemic is something that's protected the American consumer. They're highly uncertain. So many of the factors that, Bill, that you mentioned, we don't know how they're going to unfold. So I would expect a bumpy ride ahead as these uncertain factors start to unwind, either positively or negatively, and we'll see how things pan out.
Thank you. And Kartik, and after Kartik goes, Tom, you're welcome to offer some takeaways too, if you'd like.
Yeah, so I think I don't disagree with anything that's been said. What gives me optimism is what we talked about earlier, that we're dealing with a period of inflation that so far is much shorter, much less violent, much less spasmodic than anything that we've experienced in our own past. And we're coming to it this time with an appreciation of what we could do differently than we did in that period. So this is not uncharted in that sense. And I think that gives me a lot of hope, along with the inflation target and the way that the FOMC is talking about its resolute outlook on dealing with it. So those are things that leave me feeling in a good place.
Yeah, and I just say I appreciate each of our panelists making the time. Bill is my go-to person to get insight on what's happening in the economy. He's always opinionated, always insightful. Joanne, one of the great experts on what consumers are thinking, very helpful to learn from you. And Kartik is the rock who helps make me successful every day. So thank you for that. And I appreciate you guys being here. We do learn from the communities we're in. We're very aggressive about it. And we appreciate the chance to learn from you. I think the hardest thing to have in this kind of environment is perspective. We've talked about the 70s. That's one good way to get perspective. I mentioned up front that the 10 years before COVID were the most stable years in any modern economic history in terms of with GDP or price increases. And so everything seems crazy today. By the way, I think we've lost, what do you say, $1.5 trillion in housing wealth? That was right after we gained $4 trillion in housing wealth. So the net of that's about 2.5. The stock market's down 24%. That's right after it was up 43%. So we're up 19. I mean, there's a bit of sort of making sure that you see the longer path as we go through this particular very volatile place. And I think when we look at the longer path, whether it be historical or forecasting, we see returning to a stable place, not an unstable place. That means, of course, we've got to do what we do to get there.
Well, thank you so much. This has been a really rich dialogue. I really appreciate all of you being here, being willing to share a range of viewpoints. That's really what makes these conversations better, makes our policymaking better going forward. So thank you to all the panelists. Thank you so much to the audience for coming and for your questions. This brings the formal program to a close. If you're joining us online, there's going to be a survey link QR code. Please do fill it out because it will help us make events like this more helpful in the future to you, which is the point. So please fill out that survey. Make a note to join us for the next District Dialogues session on February 23rd, and that's going to be on the future of the housing market. Not much to talk about there, right, Bill? So please join us for that. We're looking forward to that very much. And at this time, if you're here in person, please join us out for dessert and refreshments and more discussion with the panelists. Thank you all so much for being here today.